In this video, I'm going to talk about some of the recent Trump policies that are getting enacted and what those could mean for your stocks and the markets in general. And then talk about some ways that you can help assess what the potential risk is to your portfolio and what you can do to help weather the storm. Welcome back. This is episode 244. Over the past few weeks, there's been a lot more volatility than usual in the stock market, and much more of that volatility is being caused by recent decisions by the Trump administration. And I want to talk about what some of those policies are, how they're being implemented, and what impact they might have on your portfolio, as well as wrap up with some suggestions of how investors can weather the storm and manage this volatility that they're seeing. If you're new to my podcast, then welcome. If you're a return listener, then I thank you for your continued support. As you know, my goal is to help educate you on how to plan the ideal retirement. And one way I educate folks is through my in-person retirement planning workshops. If you live in Connecticut, local to where I am, classes are going on right now, and I still have a few spots left in my classes in Middletown. Just a reminder, it's a comprehensive 2-night course where I educate you on many of the topics you need to understand to plan the ideal retirement. To learn more, head over to retirewithryan.com and click on courses. If you don't live local or the dates don't work for you, you can still get the same great information, and I have it available through an online course. That is also available by clicking on courses over at retirewithryan.com. So I was recently on a conference call with JP Morgan, and it was headed by their chief global strategist, David Kelly, and he talked about the potential economic impact and market impact of the recent Trump policies. So I want to share some of that information with you. I'm going to give you a high-level overview. It was an hour conference call. So I'll give you some of the bullet points, and as I said in the beginning of the episode, then I'll talk about what some of my thoughts are on this, as well as some suggestions I have to help weather the volatility that we're currently seeing. So let's talk about where we are. So David Kelly started out with a summary of the fourth quarter. The U.S. economy grew by 2.5%. The inflation rate is 2.5% on a year-over-year basis through the fourth quarter of 2024. The employment rate is 4.25%, and the forecasted growth for 2025 was 2%, probably avoiding a recession but having some inflation. And potentially declining to 2%, inflation that is, due to falling shelter costs and auto insurance inflation. As far as where the financial markets stand, we came off a great year in 2025. The S&P 500 returned almost 25%. That was followed by a previous year of plus 20%. But currently, to start 2024, the S&P 500 is down about 3%. I'm recording this on March 6th. Bonds are currently beating stocks for the year. And if you can measure bonds in a lot of different ways, but I'm looking at the 20-year Treasury Bond Index fund. There's a number of them out there. I follow SPTL, and that's up 3.21%. So that's a pretty big outperformance so far to start the year. Now we're only through 2 months of the year, roughly. Gold is having a great start to the year. It's up 9.68%. Bitcoin is really having a difficult start to the year, and Bitcoin is down about 9%. Now, the markets definitely like certainty, and we're in a period where there's a lot of uncertainty, because we don't know what the possible long-term impact of the tariffs are going to be, and we don't really know if the tariffs are even going to be there, in a couple weeks from now. So let's talk about what's going on right now with tariffs. There's a 20% tariff on all Chinese goods that started at the beginning of the year. There is a proposed 25% tariffs on Mexico and Canada with some potential exemptions. Now, I heard earlier today that the tariffs on Canada, some of them were actually going to be suspended for another month. If you remember initially when these tariffs were enacted that there was a month delay given in them after they were originally set in place for Canada and Mexico. So, we'll have to wait and see what happens with that. There's proposed tariffs on aluminum, steel, and automobiles, especially coming from Europe, and there's additional tariffs on other European goods that are being discussed. So the current average tariff rate is about 10.1%, and that's the highest rate since 1946. As far as what the economic effects could be, obviously they could be inflationary in the short term, and they could lead to slower growth in the long term. And uncertainty, as I mentioned earlier, is really where we stand with these tariffs. We don't know what they're going to be, and that's what the markets hate. The reason for this increased volatility is because it's hard to predict what future returns are going to be in the stock market. Returns of the stock market are always based on future profitability of companies. What is the future company's returns going to be? How much money are they going to make? And those prices of stocks are based on what the expected future earnings of these companies are going to be. Well, if now there's tariffs going into play, how is that going to impact these companies? Obviously, some of that cost will be passed on to the consumer, but some of that cost cannot be immediately passed on to the consumer and can lead to reduced earnings in companies, which therefore will lead to reduced stock price. What about immigration? Well, obviously, this was a key focus of President Trump, and there's been increased deportations, averaging about 600 per day, significant decline in border crossings. That was a big keystone of his campaign to shut down the southern border. He's, by all measures, largely succeeded in doing that. There are about 8,000 apprehensions at the border in February, and that is down from, I think, 47,000 the previous month, and then I think it was 147,000 the previous December or the previous February in 2024. Traditional immigration visas, 670,000 people came in 2024, and most of them are likely of working age. So because of this reduced immigration, there's a potential shortage in the labor supply. We'll just have to see, what happens, because obviously a lot of baby boomers are retiring. So this could lead to a labor shortage, but it could be good for workers because it could lead to increased wages, which is something that wages had been stagnant for a long time, and they had increased in recent years due to a shorter labor supply. What about government cutbacks? Well, obviously, you're well aware that there have been a significant reduction in the federal workforce. About 75,000 federal employees have retired or been laid off. So this could have an impact on the economy. Could be about a 10% reduction in total jobs for federal employees, and can reduce payroll employment by about 0.2%. And additionally, there's a reduction in NIH grants, potential Medicaid cuts, which could affect state and local governments. So overall, definitely a negative effect on business in the short term. So to kind of follow up with what David Kelly was saying, these policies, tariffs, immigration changes, and government cutbacks are slowing the economy, but they've not yet caused a recession. They might not cause a recession. So there's definitely concern about the long-term effects of these policies, especially if they're taking further. They could lead to a recession, but despite this, it doesn't look like we're going to go into recession in the first quarter of 2025. And as I mentioned earlier, we don't know if these are permanent or temporary policies. Obviously, the government cutbacks are probably more permanent, because even if the administration wanted to reverse course, it would take a while to rehire and fill these jobs. But the tariffs are something that are probably could be more temporary. They could be used as a bargaining chip, right, to get more favorable terms for the U.S. I know that a big focus has been to try to reduce the flow of drugs into the country, of fentanyl. So that is possibly a reason for this. We'll just have to wait and see. So what should you be doing with your investments, your portfolio, to protect against this volatility? Well, the first thing I always recommend is knowing what your asset allocation is. How much do you have between stocks and bonds? Very simply breaking it down. If you're getting close to retiring and you have a highly concentrated portfolio in stocks that you've done very well in recent years with, it could make sense to think about cutting back on your stock exposure. When you get to within 5 years of retirement, it's a critical point where if there was a major sell-off in the financial markets, if you saw a 20 or 30 or even horrific 40% decline in your retirement savings because they were all in stock funds, that would be detrimental to your retirement. So if you're in that position where you're highly invested in stocks, you might want to think about assessing your allocation, possibly putting more in bonds, more in cash, to set some money aside that won't be impacted by a correction in the financial markets. So that's first and foremost. So if you have an asset allocation, you should check how your asset allocation currently stands with what your target allocation is. For all our clients, we have a target allocation, and we watch that. And if the stock allocation goes up, we take profits and we rebalance back to that allocation so that our clients aren't taking on more risk. If the stock allocation goes down because stock prices go down, we buy more stocks to take advantage of the decline so that when things come back, our clients will be able to profit from that. So everyone should be doing that. It's a simple thing. You'd be surprised how many people I meet with, prospective clients, who either don't know their asset allocation or they tell me that they're a conservative investor, and I find out that they have 95% of their portfolio invested in stocks or stock funds. That's not conservative. So get a handle on your asset allocation. Secondly, if you've been highly investing in growth stocks, then you might want to get more diversified. The Mag 7, right, the largest companies in the U.S. have really been leading the markets, and they're being significantly hit by this volatility. So you might want to think about reducing your exposure to them. Not saying that growth stocks won't still do well until the future, but they've done really well. It could make sense to cut back on your allocation to them. So make sure that you're diversified. You're not just in growth stocks. You also have some dividend-paying stocks. You have some small company stocks and some mid-company stocks. That's a diversified portfolio. It would have hurt your returns in the last couple of years because large cap and large cap growth stocks did so well, but it's much more balanced approach and can lead to smoother returns and can also protect more of your downside if you see a certain sector really fall off or do very poorly. So a beneficiary of these tariffs could be international stocks. International companies that do a lot of business outside of the U.S., obviously, if they're not doing a lot of business in the U.S., might not be hit as poorly with tariffs or affected as poorly with tariffs. So it could be possible to consider increasing your international exposure. That still is challenging because in recent years with the war in Ukraine, it has been challenging to invest in international stocks. It's also been a long period of time where U.S. stocks have outperformed international stocks for a number of years. I've talked about it in past episodes. So that could be something where maybe you increase your exposure a little bit. It's really up to your personal preference. And as a reminder, if we just look at the S&P 500, for example, volatility is nothing new. If we look back over the last 42 years, since 1980 through 2022, I found a chart that shows the performance of the S&P year by year and also shows what the inter-year pullback is, meaning what is the largest decline that the S&P 500 had in those years. So in 22 of the 42 years, more than half of the time, the S&P 500 saw a double-digit pullback within the year. So it is not uncommon to see double-digit declines in just the S&P 500 during the year. And every year there was a market pullback, it had an average decline of 13%. So 10% or more is not uncommon, an average decline of 13%. And in the years where the S&P did experience a double-digit decline, 14 of those 22 years, or 64% of the time, the S&P 500 ended the year with a positive return. So just because the S&P 500 goes down, I know it's been a little while since we've had a decline within the year, doesn't mean it's going to be a bad year for the S&P 500. We could see further declines from here. We've had many past years where we had a very bad first quarter, but winded up with a great remainder of the year. So this is nothing new. I wouldn't give up on your portfolio, on your investments. It's been kind of easy the last few years because we've had such strong returns, but you have to stay the course. And if you're investing for retirement, This is your retirement money. You're looking to live off this money by spending a combination of the dividends and the growth of the money. You don't want to just bail out because you're hearing that it's going to be a bad year for stocks. I'm hearing on the news, on the financial channels, that people know this is going to be a crash in the markets, and it might be, as they say, a broken clock is right twice a day. But in this case, it's impossible to know what's going to happen. From day to day, we don't know what the mindset is of President Trump and his team. How are they managing these tariffs? What the purpose of this is? And we could find out in a month that all these tariffs no longer exist, and now the markets, march upward. Or they could exist for a while, but companies could adjust to the new normal and figure out how to still be profitable. So in either case, again, know what your asset allocation is, make sure you're diversified, and realize this is nothing new. It's always the best thing to be invested in the market because you make money by being in the market and not timing the market. Meaning you can't guess when the market's going to go up or down and jump in and out and do it successfully. If it could be done, someone would be doing it, right? If we knew when the next market sell-off would be, everyone would try to sell at the same time, and then everyone would not be able to do that because you have to always have someone willing to buy your stock from you to do that. So you can try to do it, but I think in the long run, you're probably going to hurt yourself and cost yourself positive returns in your portfolio. So, stay calm. This is nothing new. Stick to the principles I've mentioned, and you should, have a successful, investment, and it should allow you to be able to continue to approach your retirement goal or stay retired and generate the income that you need. So as always, if you have a question and you want to have it considered for a future episode, head over to retirewithryan.com to click on Ask a Question and consider signing up for my in-person classes, or if it's more convenient for you, consider signing up for my on-demand course as well. Have a great week, and I look forward to talking with you next Tuesday. Take care.